Today we're going to sort of start with something that may seem rather arcane, this question of capital flows from in international trade that may go from certain countries to other countries. And it turns out that in lecture halls around the world, some 20 or more years ago, people were spotting a particular puzzle in that most of the models that we worked with were telling us that capital should be flowing from richer countries to poorer countries. And increasingly, when we looked at the data, when we looked at the facts, we found that capital was going the other way. Now, for those of you who've come along to the lecture so far, or indeed have any links with economics, will understand that we're often as wrong as we are right. And it's, in fact, it's that difference between being wrong and being right that gives the science its interest for me. It's the residual, it's the error. It's the things when we expect things to happen and they don't happen in that way that makes us think a little bit harder. And indeed, we had to think very hard about what the reasons were that capital seemed to be flowing the wrong way. But it's becoming increasingly clear from a number of commentators that this, what might be considered an arcane matter, turned out to be the root cause of the financial crisis, the root cause of the shocks to the banks, the shocks to the financial sector, the need to rethink the monetary and financial constitution in Western economies, and to some degree also responsible for what we might think of the long and sustained hangover, in the sense in which I don't think we're back to normal. Interest rates, policy rates, bank rate continue to be 0.5%. If we look back along the long stream of history, 0.5% cannot be considered to be normal. We continue to run budget deficits, which I don't make any comment on in a political sense, but we're kind of saying if we're running deficits, probably the economy itself is not back to normal times. It's not back to full capacity. It's an indicator of that as well. And now we're on the stage where next year we're going to enter the 10th anniversary of the start of the financial crisis. So it's not something that's disappeared very quickly at all. And so it turns out that this arcane bit of open economy macro that we'd have in our lectures given to undergraduates or postgraduates manifested itself domestically in Western economies. A whole bunch of global developments that I'm going to try and outline, which involve the increasing encroachment, and I don't mean encroachment in any value-laden sense, I just mean increasing significance of new and emerging economies and what we might call the old world order. And so I want to consider why we thought it was a puzzle, that capital was going the wrong way, and then I want to sort of think about the implications as far as we can within the time that's available to us. In the transcript or handout that I'd encourage you to read, as well as the slides afterwards, I give you a selected number of readings that you may want to follow up in your own time to understand these issues better. It's an area of extensive study in modern macroeconomics, and I would encourage us all to get to grips with these questions. Hopefully this will click me on. Now we'll start with a little bit of literature. Two ideas I want to draw upon. One, an ancient idea of Sisyphus, talked about in a short story by Camus in 1942, The Myth of Sisyphus. And you'll remember the story. I've used a translation here, that the gods had condemned Sisyphus to rolling ceaselessly a rock to the top of a mountain, whence the stone would fall back of its own weight. They had thought with some reason that there was no more dreadful punishment than futile and hopeless labour. We might want to think this capital flowing the wrong way might have been some Sisyphean tragedy that the global economy was suffering, in the sense in which capital was flowing the wrong way. At some point, gravity is going to want to take over and take that capital back to where it wants to go. And at that point, maybe there was a crisis. If we don't stop Sisyphus is going to continue to take the capital back up there again, and we're going to lead to problems again in the future. And that's why people are worried increasingly about emerging economies, their impact on the world. That's why small changes in the renminbi, small perturbations in what we think are distant, faraway economies have tremendous repercussions for our own domestic activity. And we'll think about some of the implications of those later on. Later on, Calvino considers a problem that economists have also wrestled with as well, is that we might have hoped that following the financial crisis we've reset in the sense in which we've got everything back to zero and we can start again, and maybe we can let capital go the right way. But what happens, of course, is after a number of opportunities and causes, there are consequences. And economists have to deal with the fact that our future opportunities are often constrained by previous actions. We're not able necessarily to have an unconstrained choice going forward, because what's happened in the past limits the set of choices available to us. And Calvino, in a wonderful book, talks about this very clearly, and he says, this is what I mean when I say I would like to swim against the stream of time. I would like to erase the consequences of certain events and restore an initial condition, something economists talk about a lot, somewhere where we start from a point where everything's balanced. Actually, it never has been and never will be, and it's a very hard problem. But it's, of course, one thing that economists are often blamed for. We start with an initial condition where everything's sorted out. In fact, we typically have to start from an initial condition where there's a lot of trouble around the place. But every moment of my life brings with it an accumulation of new facts. And each of these new facts bring with them consequences. So the more I seek to return to the zero moment from which I set out, the further I move away from it. And this is the kind of heart of the problem that we have in thinking about how to deal with the world in which we now understand better the implications of these capital flows, but in a world in which they still continue to accrue in the way that they have in the past. How do we actually limit these things? And we'll go through a couple of possible solutions during the course of this lecture. What I've called Arcane Algebra, which of course I make my living from, so I apologise for that, suggests that rolling Sisyphean capital uphill cannot be stable. It's not something that ought to happen. From first principles, it looks very odd. And the consequences of this odd behaviour, in inverted commas, were both the financial crisis and the continuing rocky recovery I submit to this room today. Let's have a look at Sisyphus here in blue. Let's think about the way economists think about output in the economy and the way it's produced by a combination of factors of production and productivity. Not words, I agree, likely to keep you awake on a Thursday evening, but I'll do my best to keep you entertained as far as I can. So, what do we have here? We have poor Sisyphus, a blue chap, because he's unhappy. I think blue is a shade associated with unhappiness. And what we have on the horizontal axis, or the x-axis, is a production function. And we're saying that along that axis we have a level of capital K. The superscript there, it just says low, so a low level of capital employed and a level of productivity. So our production function in this economy is just combining a level of capital with an amount of productivity, and if I combine the two, I get a level of output, YL. So that's a production function. That's when people talk about the level of output in the economy, what they typically have in mind is just something like that. Two arguments, really. Capital, we can extend it to include labour, plus something measuring productivity, which is how much output we can get from every unit of input that we use. That's all we've really got to as economists. It's incredibly simple. The thick dotted line traces the mapping from the level of output, the level of productivity and the level of capital employed to a given level of output. And I've drawn it in a particular functional form. Perhaps I could have drawn it in a different one, but I just wanted to say it's non-linear, but that doesn't particularly matter. It could have been a linear line. It doesn't especially matter. I guess I've got increasing returns here, but it doesn't especially matter. So what we're saying is that in the world of the emerging economies, we've had capital being sent uphill. Capital is being exported from the countries with low income to countries with high income. And that's a particular puzzle or paradox, because if we think about the marginal return on capital, so for the only difference between AKL and AKH, given, let's assume that A is the same in both cases, the level of productivity in both economies is the same. They've both got access to world knowledge, the internet. They've both got access to blueprints from Apple or whatever it is that causes productivity out there. And so the only difference is the level of capital employed. And we tend to think that the more we employ capital, the lower the marginal rate of return. So if I employ a little bit more capital, it's going to be harder for me to find projects with high net worth on the margin. As I employ more and more capital, the marginal unit that I employ is going to find it harder to find higher and higher net worth returns. So at some point, diminishing marginal returns will start to set in because all the really high value projects have already been used up in the economy. So what's left are lower return projects. So what we therefore expect is a world in which we've gone from a low level of capital employed, which is consistent with a low level of output, to a world in which we've got to, with a high level of capital employed, which is consistent with a high level of output, we've employed more capital by the time we get to KH. Because we've employed more capital, the marginal return on that capital has fallen for the reasons that I've just given. Now, if the marginal return on capital at AKH is low, and yet the marginal return on capital at AKL is high because I've used less capital, I haven't used up all the opportunities in that country, it seems odd because I'm sending that marginal unit of capital away from the country where the marginal return is high, and I'm sending it to the country where the marginal return is low. That's not what investors in the City of London tend to do. They want to send the marginal unit of capital to where the return is highest. And this is the puzzle. The puzzle is that if I'm in a high-income country, I've got a high level of capital employed. Because I've got a high level of capital employed, the marginal return on my capital should be low. I therefore shouldn't be the recipient of capital. I should be sending my marginal unit of capital to a poorer country where the marginal return is high. That's what we'd expect to find. So these flows are Sisyphean. The things that don't make sense. The capital is flowing uphill. Just like the wind, we expect capital to flow from high to low. And indeed, in the last couple of decades or more, since capital account liberalisation, it's mostly flowed the other way. Let me illustrate with a simple fact. This is the UK's net international investment position. And just think of that as the difference between overseas assets held by UK PLC and liabilities of debt that we owe ourselves to overseas on the other side. So it's the difference between our gross assets and gross liabilities with overseas agents. And we've plotted this as a percent of GDP, so just relative to the flow of income in any one year, just to give you a scalar to understand the number. Otherwise we just have trillions there and billions that don't necessarily make a lot of sense. And so the UK we think of as an advanced economy, an economy in which the level of capital is high, in which income is high, one of the top 10, 5, 4 richest parts of the world, and certainly once you come to London, you're very much in the top income part of the world without much of a doubt. And therefore, if capital is employed to a very high level, we'd expect the marginal return to be low, which would mean that we, on balance, rather invest abroad, rather than borrow from abroad and import capital. This would therefore mean we should expect, since the period of capital account liberalisation in 1979, we ought to have been building up assets abroad and not borrowing from abroad, which would have meant this line would have been heading north rather than south. And what we see is that, okay, there's been some volatility to it, but we've mostly gone from being a positive creditor in the range of 10 to 20% just over 30 years ago, almost monotonically. I've just drawn a trend line in there. You can take it or leave it. It's just a sort of simple linear trend. But it looks like over time, we've just moved increasingly into debtor status, which means that we have been borrowing more from abroad than we've been investing abroad over that long time. And so we've ended up today with a net debt position of around 20% of GDP. And that, in balance terms, is about £350 billion. That's the actual quantity of net debt that we have, which is spookily similar to the size of the Bank of England's quantitative easing pot. I'm sure that's just a complete accident. Underlying that, of course, are gross liabilities and gross assets. Gross liabilities are about 10 trillion, and the gross assets are just a fraction under 9.7 trillion at the end of 2015. Now, just one lacunae or caveat to that. In the past, heading towards debtor status may not have mattered, because we were rather good at getting a higher rate of return from our overseas assets than we had to pay on our liabilities. In fact, Philip Lane, who's now governor of the Central Bank of Ireland, put out a paper last year. We estimated in the recent past the UK was able to get a rate of return of around 8% on its assets abroad and only have to pay 5% on its liabilities, which in those circumstances means that you can run debt at a reasonable level. So even at 20% debt, you'd still be running a flow surplus every year, because the gross returns on your assets at 8% times 9.7 would be more than the debt you'd have to pay on 5% times 10 trillion. But what's been happening in the last decade or so is that those differences have started to disappear, as many parts of the world have found interest rates converging. So we can't rely on what has been called in the past exorbitant privilege anymore, that people may be prepared to lend to us for less money and we can get a higher rate of return on our assets. And what this then means is that going forward, this is going to constrain activity and or possibly make the economy very vulnerable to external shocks. Because the exchange rate, of course, is the thing that's clearing today, so that this, in expectation, this difference between assets and liabilities, is cleared at some point in the future. And if we're in debt and we're having to pay flow returns on our net position year to year, that's going to put continually downward pressure on the exchange rate, because we're trying to stimulate more exports to pay off the future debt flows that result from this net position. That's one of the reasons that maybe the advanced economies are showing more vulnerability to foreign exchange shocks than they had in the past. They've got this underlying debt position that they didn't have in the past. So this is one thing. The facts themselves show that an advanced economy such as the UK, and it's not unusual, has not been running up surpluses on external account. It's been generally running up deficits and borrowing from the rest of the world. Now, if we'd been reallocating capital to more productive parts of the world, in the sense in which we're sending it to worlds in which capital is less heavily employed, so its marginal return is higher, we would expect real interest rates on average in the world to be rising, because we're reallocating capital from low productive areas to high productive areas. On average, that would tend to raise real rates. And in this swathe, what I've done is simply look at G20, which is a proxy for advanced economies, the 20 largest or most important economies in the world. And I've looked at their long-term interest rates since 1990, up till 2 or 3 years ago, and the thick black line in the middle is the average of those G20 real rates, and the lines to the north and the south are just the inter-quartile range. So it just picks off 50% of the G20. So I'm taking out extremes, essentially. That's why I'm using the inter-quartile, just to sort of give you an idea. Because any one country that you sample any one year may have a crazy number in it. So you get rid of that by just looking at the inter-quartile range. And what you can see is that, without making a big play on it, I'm not running anything very complicated here, I'm just looking at the numbers, real rates seem to have been falling. So rather than capital having been reallocated to more productive areas where the real rate of return is higher, consistent with this problem of capital flowing the wrong way, we've been reallocating it on average to lower rate of return areas, and that's led to lower real interest rates. And in a few minutes, we're going to try and understand that process. Let's be clear, there are structural reasons for this. Is long-run propensity to save in certain parts of the world, and also there are conjunctural reasons. Clearly, since the financial crisis, central banks, particularly in advanced economies, have run extraordinarily accommodative policies, not for 1 year, but many years, and that has acted to reduce real rates across the world in some sense. And as well as that, and we'll come to this a little bit later, the countries running surpluses have, rather than sterilizing the inflows of capital into their countries, have also accommodated those inflows by allowing interest rates in their countries to fall as well. So we have all these kind of global effects driving down real rates across the world, which is consistent with this idea of capital flowing the wrong way. Before I go on, let me kind of outline what the expected story was. An expected story was kind of something like this. This is the kind of neoclassical story that we were learning a quarter of a century ago. We've got our high-income countries to the right, we've got our low-income countries to the left, and what we kind of wanted was technological transfer through capital exports from the high income to the low income. That would allow them to accrue capital in a particular way, as well as perhaps learn ways of doing things by actually carrying them out, that would raise their income levels. So you'd get, one, this transfer of knowledge, and two, the raising of income levels. There still may have been a difference, which is this second dotted line you can see up there, but it ought to have led to a reduction excuse me, in income inequality and some convergence. Actually, we've seen the convergence, but perhaps not through the process we might have expected. It's not been through this capital flow process that we'd envisaged happening. But this was the model. This was the thing that we were telling transition economies and others a quarter of a century ago would happen if they opened up their markets. Now, it's a little bit of algebra, not because I want to force people to leave the room, but it's just a little bit easier sometimes to see arguments with a few letters in place. It's not, it's very simple, but it helps us understand some of the arguments out there. So let me just run through this fairly quickly, and I just want to give a citation to Robert Lucas, who perhaps first was the person to write down this paradox. So we've already discussed output. Output is Y. It's a function of productivity, A, the level of capital employed, raised to alpha, which is the share of capital in output. So we have just a simple linear production function. Now, let us suppose in the first instance that all countries have access to the same A. And that's because there's globalization, there's trade, as I've said, not in 1990, but subsequently there's the internet, there's all kinds of things that mean in the end, we hope knowledge will be transferred in such a way that we've all got access to the same A. Then it's only in that world variation in capital employed that's going to explain if countries I or J have different levels of output. It can only be capital employed in I or J that because it's the only thing that I've allowed to be different in this very simple equation. Now, if I differentiate this equation with respect to K, I get what is the rate of return on capital or the real interest rate. And that's going to be R equals A, small a, capital A, K to the A minus 1. And A is a share, so it's somewhere between 0 and 1. So A to the minus 1 is a minus number. So that just is an arithmetical way of making the same point that I said earlier on, that if I raise the level of capital, the interest rate will fall. Simply saying arithmetically what I've already explained intuitively. And that's kind of useful because if I do it arithmetically in this way, I can then illustrate quantitatively the effects that I'm looking to expect to see. That's where I'm going to go to in a minute, and that's why I want to write it down this way. So we can see now that the interest rate is essentially a negative function of the quantity of capital employed. If an economy is richer because it has more capital employed, it must have a lower interest rate if this relationship is correct. Indeed, I can substitute, if I play around with the first equation, divide by A and take y over A to the power of 1 over A, I can substitute that expression back into K, and then I have an exact expression between interest rates and the level of output. And that just says what I've already said, is that in the same way that interest rates fall in the quantity of capital employed, interest rates will fall in the level of output, because the level of output is a function of the level of capital employed. That's all we're saying here. So, we've now arrived at the statement, which is the puzzle. At high levels of income, the rate of return on capital is lower than at lower levels of income. This means that if I'm a capitalist and I want high rates of return for my future life when I have a pension or I have payoffs that from a world in which I'm not saving anymore, I've got to send my capital to where the returns are higher. And that means low-income countries. Now, because I've written it arithmetically, I can also look at the scale of the puzzle. Because what I've done here on the y-axis, I've said, look, I'll look at the ratio of output from a rich country to a poor country. And the way to understand this is that at 1, I've said the output in the rich country is the same as the output in the poor country. The ratio is 1. At that point, the returns are also 1. The returns will be the same. They'll have the same interest rate. As the ratio increases, so if I take a country which has 10 times the income per head of a poor country, you can see that the rate of return, depending upon the fraction of capital in output, don't particularly want to get into that, you can easily see the rate of return is a very small fraction in the rich country of what you would expect to find in the poor country. It's a third or less. So, if in the rich country the rate of return is 3%, I would expect in a poor country that has an income per head of a tenth of that, the rate of return should be 10% or more. That's the size of the puzzle. Now, if you can invest risk-free at 10% or more, why would you invest in a rich country at 3%? This is the puzzle. This is the confusion. This is the problem. And what we'll find later on is that it's one distortion, this particular distortion, that was multiplied with lots of other distortions when we add them up that led to the financial crisis. And this is the main reason why macroeconomists like to think in general equilibrium. We don't want to think in this market alone. We want to understand, if this market is distorted, what other distortions are there in the world economy that follow? That's the really interesting thing for us as we add up all these problems. So here we have the basic problem. If I have a part of the world that is 5 or 10 times richer than another part of the world, the rate of return should be 3, 4, 5 times less than it is in the poor part of the world. And if I'm a capitalist, why don't I gobble it up? Well, there may be some ways of getting rid of the magnitude of the paradox that I've put to you today. So let's think about 4 arguments. One is, let's suppose that workers are more effective in the developed world. Let's suppose that's a kind of probably politically incorrect thing to hypothesize, but we're just thinking aloud as much as anything else. Let's suppose in the first instance that workers are more effective in the developed part of the world, so that we need more workers in the developing world to carry out the same amount of activity. That would then reduce the sort of relationship between output, because it wouldn't be a relationship anymore between output per person, it would be a relationship between output per effective worker. And that would scale down the rate of the problem. So a country may have 10 times more income per head, but it may only have 5 times more income per effective worker. So part of the problem may disappear if we start to deal with labour productivity. That's one thing we might want to use. Second thing we might want to use is, I made the argument earlier on that we assume that everyone is pulling from the same pool of knowledge. The level of productivity is something we can all access from wherever in the world we may be. But that may not be true. It could very well be that we have access to higher levels of productivity. So AI may be different in rich countries as opposed to poor countries for all kinds of initial conditions, all kinds of educational reasons, all kinds of transport, infrastructure types of reasons that mean that even if that global pool of knowledge is available, it cannot be effectively employed in developing countries. And that could be institutional, it could also be political. It could be all kinds of reasons that mean that A is not effectively the same in these economies. And of course we can extend that argument by having another argument in our production function. We've got productivity A, we've got capital K, but we could also have a term in human capital. We can say, well, the human capital is maybe our universities are more productive or better even. I don't want to pursue this point too much, because it seems to me if we're going to say that the developing world can't access knowledge, then that seems to go against the very grain of globalization in the first place. Because globalization is a world in which we are sharing ideas, we are sharing human capital, and therefore we can't pursue an argument about segmentation permanently in a world of globalization and trade. It must be a world in which we're sharing. So I don't think 1 or 2 are great arguments when you start to think about it. They may be temporarily appropriate, but they can't be permanent explanations of this difference, it seems to me. Let's go to another type of story, and that's dynamic inconsistency. So let us suppose the story is the following. I am living in a wealthy country, and let's suppose I want to export some capital to a less wealthy country because the returns are higher. I'm building up savings in that country, I'm building up assets there, net foreign assets in that country, and I'm building them up because at some point I want the returns, and I may want to draw down those assets when I stop working. Just think of it as the same as a pension pot or whatever else it might be. My pension pot is being built up by claims on abroad. Fine. So I'm building up those claims with the view at some point in the future when I'm old of drawing down those claims. Now, if that country decides to change its behaviour, because what's it got? Well, at some point in the future, it's got all this foreign capital embedded in its country, and it's using that foreign capital for production, and it's used it to converge on income levels in the rich countries. That country may find its incentives have changed. That country may decide, hang on a minute, we've got all this capital. Do I really want to give it back? Maybe I can keep hold of it. Maybe I can nationalise the industries here. Now, I'm not saying, please understand me, I'm not saying it's necessarily going to happen. I'm saying it's a possibility. So the country may say, we've suddenly got all this capital invested in our country. Now, these people from the advanced economies are now going to want the capital back, or they're going to want profits remitted back to their countries. Actually, you know what? I might change the regime. I might tax the capital, or I might decide to nationalise the capital, because I think it's better for me to keep it here rather than give it back. Is that the end of the story? No. Because when I go back in time, the initial problem is, as an individual in a rich country today, I can foresee that possibility at some point in the future. I've already worked out at some point in the future, if I dump 100 trillion pounds of assets in a bunch of overseas economies, that they may change their behaviour and nationalise or capture those profits and not allow me to remit them back. If I think that is a possibility, what happens? I don't remit in the first place. There's the tragedy. Because there's no credible commitment device for those economies to return the capital, I don't even send any over in the first place, and those countries never converge. So the possibility of dynamic inconsistency in behaviour, that's what I mean. The countries themselves who are poor wish to have the capital come in, but at some point there may be an incentive to change their behaviour, and that's what we mean by inconsistency. And it's the possibility of that inconsistency that may prevent capital itself from being remitted in the first place. That's one problem. The other problem might be in those countries there may be a form of protectionism. EDCs, emerging developing countries, may have monopolies, and these monopolies may have political power and may not wish to have their practices challenged by foreign capital. If there's more production in those economies, the existing domestic producers of goods may find their monopoly power eroded, their excess profits taken away, and their political power threatened. And they may therefore want to wish to erect all kinds of barriers to foreign capital coming in, which itself may prevent the convergence process that we would want in the first place. So, I think you can see from the weight I've put on the arguments, I have a bit more sympathy with these kinds of issues that sometimes are rolled up into that terrible phrase used by strategists in the City of London, political risk. When they talk about political risk, I think these are the technical things that they have in mind, these kinds of problems, it seems to me, they want to quantify. Okay. Now, let's have a look at a Metzler diagram. So, the counterpart of the Sisyphean sort of diagram we looked at a minute ago is really this kind of story, and we shouldn't have too much trouble in understanding this. On the left-hand side, we have our advanced economies, and we have savings and investments schedules. R is interest rates, and along the bottom you can think of as quantities of investment or savings. That's simply saying that at lower interest rates, we're going to want to invest more, because even if the marginal return on capital falls at lower interest rates, I can justify the investment in capital, because even if there is a lower rate of return, I've had to pay less to borrow money in the first place. So we expect the schedule for investment to be downward sloping, and we have an upward sloping schedule for savings. The higher the interest rate is, the more we're going to want to defer consumption today and save instead. So we have this kind of diagram. And of course, the market for savings and investment here is going to clear at A. Because we're in a high income economy, we would expect to have a high quantity of savings. We can use a kind of marginal propensity to consume or average propensity to consume type story. But if we're in a high income economy, the fraction of income that we save is going to be a larger quantity than it is in a poorer economy or an emerging economy. And so we'd expect the interest rate to clear at A. In a developing economy or emerging developing economy, we may get a slightly different form of investment function where investment doesn't expand so quickly as the interest rate falls. Maybe we come against the kind of institutional capacity constraints that we may not see in a developed economy. But in a world in which income is lower, the pool of savings may be lower, so the interest rate we'd expect to clear at this higher interest rate. And it just is the other side of the story that I've already told. At lower levels of income, there is less capital employed, the marginal return is therefore higher, and we'd expect the market to clear at a higher interest rate. So we see that on the right. And on the left, we see what we'd expect in the developing world, higher pool of savings along with higher income, and the market is clearing at a lower interest rate. And at that world, of course, the marginal investor is going to go to B because he or she is going to get a higher rate of return. And this is what we'd expect. This is our expectation as an economist, is what we expect to find. And if marginal capital is flowing from A to B, it's the advanced economies that are building up claims. They're the ones who have current account surpluses. It's the developing economies that would have deficits. They're the ones who would be borrowing. And the average interest rate in the advanced economies would rise, because instead of giving the marginal unit of capital to an investor in the West, you'd be giving it to someone in the emerging developing economies, which would be raising the average rate of return. At some point between A and B is what you'd find. Of course, what I've already said is we've seen exactly the opposite. And so what we've seen is something more like this process, the unexpected Metzler diagram. And in this world, we've got the same investment schedule, but for whatever reason, we have a savings schedule that is a little bit further to the left. And in the absence of any trade in an autarkic world, where we hadn't opened up to the emerging economies, the real interest rate would be A. That's where we would clear our investment and savings schedules in advanced economies. Now, in the emerging economies, we have the same investment schedule, but we have a saving schedule that's shifted out to the right. We'll think about the reasons for that shortly. And that market for savings would clear at B. B is below A. If we open up these two economies, if we allow them to trade with each other, the people who want to invest can borrow from the emerging economies, and the people who want to save in the emerging economies can get a higher rate of return by lending to the advanced economies. And so what you'll see is that the excess of investment over savings in the advanced economies, where it says CAD, is borrowed from the excess of savings over investment in the emerging economies. And that's their current account surplus. And so the two will match each other. We can't have globally a current account deficit. The countries that are borrowing their excess bits of investment are borrowing them from the pool of savings in the emerging economies. And the interest rates for the Western economies, or the advanced economies, whatever you want to call them, I use these terms interchangeably, falls from A to C. At the same time, they run current account deficits. In the emerging economies, there is an increase in real rates compared to where it would be in the world of autarky, and they run current account surpluses. And so let's think about how we might solve this. So one solution might be, well, if I'm faced with a world in which we have, let me just go back one before I go in. Let's suppose we start to worry that the current account deficit in the Western economies is too large, and somebody says, you know what we need to do? We need to reduce investment. We need to stop demand. We need to do things to stop people borrowing from these economies. So maybe we'll make investment more difficult. We'll do things to reduce demand. Maybe we'll run tighter fiscal policy, whatever it may be. We'll see what happens. Well, what that will do is shift R in to that point there. And we will then have, at the original interest rate C, we'd have no current account deficit in the advanced economies anymore. But at that original point C, we'd still have a surplus in the in the developing economies, the emerging developing economies. So at C, there'd be no excess investment or savings in the advanced economies, but there would still be some excess savings in the emerging economies. Because there's globally still a pool of excess savings, that then puts further downward pressure on interest rates. Interest rates would then fall to D, and we would see once again, hey presto, the re-emergence of a smaller current account deficit in the advanced economies and a smaller current account surplus in the emerging economies, but still the imbalances would remain. We would have lower interest rates, but what's worse, we'd have a lower level of activity in the advanced economies if we tried to solve the problem that way. And I mention this because it's one interpretation of what's been going on in the last 5 or 6 or 7 years. Perhaps we've had too rapid, I'm not necessarily saying it's the case, but if we'd had too rapid adjustment in demand in the advanced economies, all that does is further lower interest rates. It doesn't get rid of imbalances and leads to a lower level of activity than we'd otherwise have seen. So, let us now think a little bit more about the implications. If the advanced economies are running current account surpluses, their investment or their consumption patterns were running far ahead of the level of savings, the original thought is that this level of excess activity would be inflationary. It would lead to negative output gaps, levels of unemployment that were too low, that would bid up levels of inflation, and would therefore end up being controlled by an inflation targeter. It turned out that these impulses didn't prove to be inflationary. At least one of the reasons is that one of the things that was supplying surpluses was the import of manufactured goods from these self-same emerging developed economies that had negative inflation attached to them. And this was acting to drag down overall CPI, where CPI is a combination of both imported manufactured goods that have negative inflation and domestic service goods that had quite high levels of inflation at this time. So to some extent we were missing part of the story. Another story might be that we've had at that time excess activity, and now we're seeing activity lower than it would otherwise be as we start to deal with the ongoing payments problems. We've talked about that in previous lectures, so I won't dwell on that too much now. The root cause we've just seen from this diagram, though, is excess savings in the emerging and developing countries that haven't recycled those savings domestically, but have chosen rather to recycle them back into the global economy and have been used there. This has acted to lower interest rates in both globally and in these economies. Now we've seen a temporary reversal after the global financial crisis in response to extraordinary loose policies, but the return of this paradox as capital now starts to turn away from the emerging economies back to the advanced economies is a further risk for the economies, for the advanced economies. As I've already said, our net debtors, the UK, US and the euro area, each of which are net debtors. The euro area itself overall is a net debtor to the tune of 10% of euro area GDP. may suffer increasingly volatile exchange rates. We just can't understand what is the appropriate path of the exchange rate that's going to clear this net debt position over the long run. There are two other issues, I think, that have emerged and amplified this shock. If we're saving more than we might expect, given the size of the economies in the emerging developed countries, but at the same time there's a lack of safe assets to put those savings into, what we might end up with is a bid up in the price of safe assets, which further lowers rates of return. And we've seen asset prices rise throughout the world in relatively safe areas as these savings have been recycled into increasingly what I might think of risky areas, but are the next bit of risk along the spectrum. And this might lead to problems that I'll come back to in a minute. There's also evidence in general equilibrium models that the only way you can explain capital flowing to high investment output countries where the rate of return is low is that there's some kind of distortion or subsidy for savings. And the only way we can get that is that there's a distortion or subsidy for savings in emerging and developing countries. And so many of these things have been highlighted and well written about by the then governor of the Fed, Ben Bernanke, when he described the savings glut. And I'll quote extensively here. If it is a savings glut in the emerging economies that's been driving down interest rates, a more direct approach, he argued, was to help and encourage developing countries to re-enter international capital markets in their more natural role as borrowers rather than as lenders. For example, developing countries could improve their investment climates by continuing to increase macroeconomic stability, strengthen property rights, reduce corruption, and remove barriers to the free flow of financial capital. Providing assistance to developing countries in strengthening their financial institutions, for example, by improving bank regulation and supervision, and by increasing financial transparency, could lessen the risk of financial crises and thus increase both the willingness of those countries to accept capital inflows and the willingness of foreigners to invest there. So, by 2005, we had an analysis, but it was kind of too late to do much about it because the claims had built up. We go back to Calvino. We can see from this IMF paper that the sheer quantity of capital flows into the green lines represent the advanced economies, into these advanced economies in the period leading up to the crisis. In fact, BIS work in 2006 by Mohanty and Turner tells us that the cumulative current account surpluses for emerging economies was some $1.4 trillion. And if we throw in another £100 billion of capital, we're talking about increase in foreign exchange reserve holdings in emerging economies of some $1.5 trillion in the 5 years leading up to the financial crisis, most of which was held in relatively safe US treasuries or other short-term debt instruments issued by advanced country sovereigns. These flows tended in general not to be sterilised, which then also meant that interest rates in these emerging economies were lower than they would otherwise have been. And what we can also see from this chart is the black line, which says that at the same time as these savings are being recycled, we can see that the activity in the financial sector, the black line corresponds to G4, the total liabilities of financial institutions in the G4, increasing rapidly in this period. This recycling allowed the balance sheets of banks to expand. Now, the net investment position at the end of 2014, we can see the UK. We've already looked at the time series of the UK, but I'm just showing this to show the scale of the problem, what I might call other countries also on the naughty step, I guess, of the world. The euro area, when we add in Germany to the others, also is a net debtor, as I've already said. And the euro area, the UK and the US are all net debtors at the moment, and this is a chart from the Bank of England's Financial Stability Review 2015. I said the UK may not look that bad compared to certain countries, but we need to remember that with the equalisation of returns on assets and liabilities, this is potentially a permanent outflow or the need to run a permanent trade surplus to stop this number from heading even further into negative territory in the years to come. The point I made about the lack of investment opportunities can be illustrated here. If we had sufficient investment opportunities, a given level of savings would imply an interest rate of C prime prime. But if we've run out of possible investment opportunities in the emerging world, the investment schedule becomes rather inelastic. So a given shift in the savings curve leads to a much larger fall in the interest rate to C prime. Now, with a fall in the interest rate, let's again, as economists, think through the implications. If we price a perpetuity, an asset that always pays off C, the price of that perpetuity is C over R. And if the world interest rate falls from, say, 5% to 2%, it means there's a 250% increase in the amount you're prepared to pay for a perpetuity. That means asset prices could rise by 250% just because world interest rates have fallen from 5 to 2%. This increase in asset prices provides the holders of assets with collateral that allows them to borrow further. It also means with low interest rates we may find the purchase of other assets along the risk schedule that also leads to their returns falling. So we see this translation of risk down there, and excess returns may start to disappear. But it also means that those, again with those initial conditions, who don't have any net worth may find themselves further left behind. It's very easy for us to, with strict lending, on the basis that it's safer not to lend to people high amounts of loans relative to income or high amounts of loans relative to collateral. But if you don't have any savings, it can be therefore very hard for you to get any gain to assets at all, or any lending. And so you might get a world in which these shocks exacerbate income inequality. That's another problem of our times. To some extent, we might think of as being related to these problems. Capital, we'd expect to be going to worlds in which productivity levels were high, but in fact, it goes the wrong way. So the work that we're looking at just, again, reinforces the point that capital just doesn't seem to chase high productivity states. It seems to go to worlds in which investment is already high and productivity is low. And we see lots of papers with these incorrect signs. And we have to think hard about what exactly is going on here. I hate to use this word, but it's bandied around very often in this area, and wonder whether the distortions we're looking at are a result of a latter-day form of mercantilism. Mercantilism, a set of arguments that say there's only a fixed level of output in the world, and if you have claims on the rest of the world, you'll become richer. It's not something that really makes a lot of sense in a world in which we continue to grow and activity continues to grow. But it may make sense to think about countries running surpluses if they think there are strategic complementarities, if by running surpluses they are able in the end to have a higher level of output than they will otherwise have. Of course, that is a zero-sum game. Not everyone can run surpluses, but it may be somewhere at the thinking behind the increase in reserves. The globalization, the vulnerability to shocks that I've outlined, means that we have to think very hard in the advanced countries about the appropriate policy and institutional responses. Our banks, our central banks, and all these guys have to think harder about how they're going to deal with asset prices that may end up being more volatile for longer. We've already seen the responses of the emerging and developed economies. They've decided to hold more reserves. They've decided to save more. We've talked about the importance of general equilibrium effects, so just take away this diagram. If we move one ball, all the others move. And that's, to an extent, what I've tried to illustrate. The one ball we moved was the shift in the savings schedule for poorer countries. And what we've seen are impacts throughout the world as a result. So just think about everything that goes on there. It looks like the emerging developing economies have been saving too much. Of course, it could very well be that the advanced economies have not been saving enough and perhaps have adopted the wrong split between consumption and investment. We haven't got the answers yet, but I think we're beginning to understand fully the problem. Thank you very much.